If you're watching this right now, the stock market looks fine. The S&P 500 is near highs. Tech stocks are booming. AI companies are printing headlines. But here's the uncomfortable question. What if the market is quietly setting up the next recession and most people don't see it? Today on Money Nebula, we're going to break down what's really happening beneath the surface of the U.S. economy and whether 2026 could be the year everything changes. This isn't fear content. This isn't hype. This is data. Let's begin. First, let's talk about what everyone sees. Corporate earnings for mega-cap tech companies look strong. AI spending is exploding. Nvidia, Microsoft, Amazon, capital expenditures are at historic levels. But here's what most investors ignore. The stock market is not the economy. In fact, it often diverges from reality before a downturn. In 2000, the Nasdaq was flying right before the dot-com crash. In 2007, markets were strong, months before the financial crisis. In 2020, everything looked stable until it didn't. So what's different now? Three things are flashing yellow. Number one, consumer debt is at record highs. Credit card balances in America have crossed historic levels. Delinquency rates are rising, especially among lower-income households. Buy now, pay later usage has surged. When consumers rely on debt to maintain lifestyle spending, that's not growth, that's pressure. And remember, consumer spending drives nearly 70% of U.S. GDP. If the consumer cracks, the economy follows. Number two, commercial real estate is quietly collapsing. Office vacancies in major cities remain elevated. Refinancing risks are building as higher interest rates reset old loans. Banks are exposed. And while this isn't 2008, regional banks are already showing strain. The headlines are quieter now, but the risk hasn't disappeared. Number three, the lag effect of high interest rates. The Federal Reserve raised rates at one of the fastest paces in history. But rate hikes don't break things immediately. They break things slowly. Businesses that borrowed cheaply in 2020-2021 are now refinancing at much higher rates. Small businesses are feeling it first. Layoffs in certain sectors are rising. Corporate bankruptcies are ticking up. These are early signals, not front-page news. Now here's the twist. If all of this is happening, why is the stock market still strong? Because markets are forward-looking, but also concentrated. A handful of mega-cap stocks are driving most of the gains. Strip out the top 7 tech companies, and the broader market looks far less impressive. This level of concentration is historically rare, and concentration increases fragility. So does this mean a crash is guaranteed in 2026? No, but it means risk is asymmetric. When valuations are high and economic pressure builds underneath, the downside grows faster than the upside. Smart investors don't panic, they prepare. So what should you actually do? First, don't try to time the exact top. That's a losing game. Instead, focus on companies with strong cash flow, low debt levels, pricing power, essential products. Second, build liquidity. Recessions create opportunity. The biggest wealth transfers in history happen during downturns. People who have cash win. People who are over-leveraged lose. Third, diversify beyond hype sectors. AI is powerful, but bubbles form when narratives outrun fundamentals. In 2000, the internet was real, but valuations weren't. The same principle applies today. Technology changes the world. Valuations determine returns. Now let's zoom out. The U.S. economy is resilient. Innovation is strong. Energy production is high. Unemployment remains relatively stable. This is not doom. This is risk management. The goal is not to fear recession. The goal is to survive it and capitalize on it. Here's something most people don't understand. Recessions don't destroy wealth. Overexposure does. Debt does. Panic does. If you build a portfolio assuming volatility will happen, you don't need to predict when it happens. That's the Money Nebula mindset. Zoom out, see the macro picture, position intelligently. So here's the real question. If 2026 brings a slowdown, will you be reacting or will you be ready? Because markets reward preparation, not emotion. If you found this breakdown helpful, subscribe to Money Nebula. We don't chase headlines, we analyze them. Thanks for watching.